What if I told you that some of the wealthiest people on earth don't make their money by working harder? They make it while they sleep. Today, we're going to reveal the exact system they use. And the best part, you can start with less than $500. There's a reason financial education is barely mentioned in schools. Not because it's complicated, but because it's powerful. Very, very powerful. For centuries, the wealthy have used a simple concept to grow and protect their fortunes across generations. It's not insider trading, it's not complex derivatives, it's dividends. Dividends are regular cash payments that profitable companies make to their shareholders, the people who own even a single share of their stock. Think of it like this. You buy a piece of a business, and that business shares its profits with you every single quarter, like clockwork. Johnson & Johnson has paid a dividend every quarter since 1963. Coca-Cola has increased its dividend for 61 consecutive years. Procter & Gamble, 67 years of continuous dividend growth. These companies don't just preserve wealth, they manufacture it. And for most of history, this information was passed down quietly, from wealthy parent to wealthy child. Today, we're breaking that cycle. Let's get specific. When a company earns a profit, it has two choices: reinvest that money into the business or distribute a portion to shareholders as dividends. Companies that pay dividends are typically mature, stable, profitable enterprises. They've reached a level of success where they can afford to reward investors regularly. Here's how it works in practice. A company declares a dividend, let's say $1.20 per share per year. If you own 100 shares, you receive $120 annually just for owning the stock. Paid quarterly, that's $30 every 3 months, deposited directly into your brokerage account. No work required. Now here's where it gets interesting. The dividend yield tells you what percentage of the stock price you're receiving as income. A stock trading at $40 per share, paying $2 annually, has a 5% dividend yield. That means you're earning 5% just in dividend income, before any share price appreciation. For context, the average savings account pays less than 0.5%. The dividend investor is earning 10 times that, simply by owning a piece of a quality business. Now this is where things get extraordinary. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he said it or not, the math proves the point. When you reinvest your dividends, using what brokerages call a DRIP or dividend reinvestment plan, you buy more shares. Those shares pay more dividends. You reinvest those dividends, you buy even more shares. This cycle repeats, quarter after quarter, year after year. Let's look at the numbers. An investor who put $10,000 into an S&P 500 index fund in 1994 and reinvested every dividend would have roughly $180,000 today. That same investor who did not reinvest dividends would have approximately $90,000. Same starting amount, same time period. The only difference? One reinvested dividends. The result? Double the wealth. This is why Warren Buffett, whose net worth approaches $130 billion, has never sold a share of Coca-Cola stock. He bought it in 1988. Today, Berkshire Hathaway receives over $700 million in Coca-Cola dividends every single year, from a $1.3 billion original investment. The investment paid for itself more than 5 times over in dividends alone, before counting the massive appreciation in share price. Not all dividend stocks are created equal. The most coveted group in the investing world is called the Dividend Aristocrats, a select club of S&P 500 companies that have increased their dividends for at least 25 consecutive years. Think about what that means. Through the dot-com crash of 2000, through the housing market collapse of 2008, through a global pandemic in 2020, these companies kept raising their dividends every single year. Currently, 65 companies hold this title. Names like Automatic Data Processing, which has raised dividends for 49 years, Genuine Parts Company, 67 years, Emerson Electric, 47 years. These aren't just investments, they're financial machines, engineered to generate increasing income regardless of economic conditions. Research has shown that over the past 50 years, dividend aristocrats have outperformed the S&P 500 with lower volatility. They've delivered higher returns while being less risky. That's the holy grail of investing, and these companies have delivered it decade after decade. So how do you build a dividend portfolio? Start with diversification. A strong dividend portfolio typically spans 5 to 7 sectors: consumer staples, healthcare, utilities, financials, industrials, and real estate investment trusts or REITs. Each sector responds differently to economic conditions, so together they provide stability. Next, look at 3 key metrics. First, the dividend yield. Aim for 2 to 5%. Yields higher than 6% can signal a company in trouble, where the stock price has fallen because the business is struggling. Second, the payout ratio. This tells you what percentage of earnings the company pays as dividends. A payout ratio below 60% is generally healthy. It means the company can sustain and grow the dividend. Third, dividend growth rate. Look for companies that have grown their dividend by at least 5% annually. This ensures your income keeps pace with inflation. You don't need to be wealthy to start. Many brokerages allow fractional share investing, meaning you can own a piece of a high-priced stock with as little as $5. The key is to start, stay consistent, and reinvest every dividend. The dividend machine doesn't care what the market does today. It doesn't care about headlines, interest rates, or elections. It just keeps paying, quarter after quarter, year after year, building wealth while you sleep. If this video gave you a new way of thinking about money, hit subscribe. We publish deep dives like this every week. No hype, no speculation, just the financial education the wealthy don't want you to have. Market Mapped. See you next week.